Our next segment is a fireside chat with Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC. Now, considering large parts of the economy have shuttled in and out of lockdown restrictions in the recent past, markets have been witnessing swings of unprecedented magnitude from record highs to record lows. So, for many investors, existing or new ones, dealing with market volatility can seem daunting, especially when it comes to staying invested and following a financial plan. So, Mahesh is our expert navigator who will show you the right way to pass these choppy waters of financial markets. Mahesh, thank you so much for joining us at the Nivesh Mahakumbh. Now, as they say, adversity can present opportunity. So how can investors benefit from periods of market volatility? What's your view on that?
Yeah, good afternoon, everyone, and welcome to the show. So you're right. I think especially equity markets, as you know, it's never a one-way journey, right? We all know that equities over the long term have given good returns. If you look at the long-term returns of equity, they'll be somewhere around 12 to 13% last 10 years, 15 years return. But it's not always linear, right? There are periods, if you look at in a calendar year, the market would have given as high as around 40, 50% return. And it could be down as much as around 30, 35% in a calendar year. So the volatility in the market is, it's the characteristics of equity markets. And it's also one of the risks associated with that. But as you rightly said, any adversity can also be an advantage. So whenever markets, normally when you invest into a market, you want to buy something which is more attractive, right? In terms of valuation, or which is a stock, for example, which is available below its intrinsic value. I think during periods of market volatility, when there is fear and we see deep market corrections, like what we saw last year during the pandemic, right? The markets corrected by almost like 35, 40% or so. That's the time you really get stocks, good quality stocks, which you wanted to buy, which were expensive and out of one's domain or out of one's framework. One can buy those at a much attractive valuation. So if you are able to, not exactly time, but during adversity, when there is fear in the market, when everybody wants to sell and get out, that's the time if you are able to really have the courage to invest in the market or probably do a larger allocation, then whatever the average returns the market have given, you can possibly tend to get returns slightly better than that. So it's place to play a bit contra, I would say, and play against the market. I think if you do that, that can potentially give you better return than the average returns which one could expect.
All right. But Mahesh, given the current volatility, is it a good time for new investors to enter the market now? And if yes, what are the things that they should keep in mind? And if no, then how should they decipher when to start investing in equities?
So the market, actually, if you look at in the last 1 year or so, it's been a one-way market, right? There hasn't been much of volatility in the market. And that is something which I think especially new investors should keep in mind, that it's not going to be a one-way street. There could be periods of market corrections. There could be periods of market consolidation. And even in a bullish market, we've seen markets correcting by around 20, 25%, which should not be a surprise. But investors looking to invest in the market at this point in time, considering the fact that the market is at an all-time high, is rallied significantly in the last 1 year, and the valuations are apparently looking very high compared to the long-term averages. But I would still say that for long-term investors, investing with an investment horizon of more than 3 years, I think they should still continue to invest even at these levels, because you never know, right, when the market will top out. So, see, fundamentally, the market is actually coming out from a bottom phase, right? We've seen a deep correction in the economy, and slowly as the COVID pandemic, is settling down, as we're seeing vaccination now coming through, I think we should come out of this phase, despite the whatever second wave and third wave what we're looking at. And our belief is that the economic recovery should pan out over the next 1 year, and it should gather momentum going forward. And on the back of that, you should see the corporate earnings growth starting to do better. In fact, this year, we are looking at around 30-35% growth in the Nifty earnings. So while the market is already at high and discounting to a large extent, I think the recovery in the economy and in the earnings, corporate earnings over the next few years will continue to take the market higher. And I think the market is set to gain higher ground even from here. So the first time novice investor, I think, since the market is already at a higher level, it's not exactly cheap. It would be advisable for them to invest into funds or stocks which are relatively less risky, I would say, or funds, okay, which are less risky, or it could also be a kind of a large cap fund, okay, it could be a fund which they can choose, or it could be a balance advantage kind of fund, right, where the equity allocation in that fund is decided, okay, by the fund manager, okay, depending on the market valuation and the market cycle where we are in. So I think those would be the entry products, okay, which a first-time novice investor who wants to invest in the market at this point in can choose. But I think clearly, one need not be aggressive at this point in time because where the market is. But clearly, one should start investing if one has already not done that. I would advise even the current level of market is good enough, and from here also one can expect reasonably good returns from market over a medium to long-term horizon.
All right. But in the context of the market going up on the back of higher earnings, what are your suggestions when the volatility phase still exists for investors with equity heavy portfolios who are worried, the markets keep going up, that's great, but they just worry, where is the end coming? So in the context of what you said, that markets will grow on the back of higher earnings, for those investors with equity heavy portfolios, what's your message to them?
So I think, again, as I mentioned earlier, the market valuations are on the higher side, right? So, but it would be prudent for people who have equity heavy portfolios and seen a significant appreciation of that, right? In the last 1 year, we've seen the markets almost double from the bottom. And the equity allocation in one's portfolio overall would have gone up significantly. So in that context, I think it would be advisable to rebalance the portfolio and try to bring that equity allocation somewhere near one's target allocation, right? Everybody would have a target allocation for various asset class, including equity, depending on one's risk profile and one's investment horizon. So for example, one's target equity allocation is say 60%, right? Which is the average allocation which one like to maintain. And because of the market appreciation, if that has gone to around 80%, then clearly I would advise at these market levels to bring it somewhere closer to that target allocation, and but continue to stay invested over there. At the same time, a portfolio would be a mix of various kind of funds or various kind of stocks which would be there. At these levels, it is advisable to probably cut the amount of risk in the portfolio. So some of the high risk funds or highly volatile funds or high risk stocks or high momentum stocks, one can actually reduce that composition in one's portfolio and move that towards more quality stocks or much more secular stocks or defensive stocks. I think that would be the right strategy at this point in time. At the same time, one should continue to maintain an equity allocation which is at least equal to your target allocation or slightly higher. It's not a time to really bring down one's equity allocation. I think there is enough room for the market to move up in the next coming years.
All right. Speaking of rebalancing portfolios, could there be a tendency to go overboard because you keep tweaking to check if something works or not? What are some of the things, in your opinion, that investors should keep in mind, specifically when rebalancing portfolios during periods of volatility?
Yeah, so rebalancing is very, very important, and that's something which we always continue to emphasize on as a part of asset allocation. And normally one would have a kind of a fixed time frame, right, where one would want to rebalance the portfolio, say once in 6 months or once in a year, where you would review and see how the allocations have moved across the various asset classes. It could be equity, it could be debt, it could be gold, it could be commodities, it could be real estate, and then take a call on that. But during periods of higher volatility, where the swings in the market could be much larger, especially on the equity side, there I think it would be prudent to actually set some kind of a some kind of a target, right? In the sense that if the allocation of equity goes say 25% higher than your target allocation, okay, then one can set a trigger, okay, to rebalance the portfolio earlier than the normal stipulated time frame which one would have normally done to rebalance the portfolio. So in that sense, if it reaches a particular target allocation, which is above the normal target, then one can do it much earlier. And I think that is something which I think I would advise specifically, especially during times of market volatility. It applies to both when the market is going up and at the same time when there is a deep correction in the market.
All right, Mahesh. And as we sum up this chat, Mr. Balasubramanian called today's world the VUCA world. So, what are the things that you would advise investors to watch out for during periods of volatility as your summary statement for this chat?
So, I think especially for people who are first-time investors and investing in the market for the first time, and we've seen that in the last 1 year, there are a lot of millennials and new young people who have entered in the market, and that's reflected in the large increase in the demat accounts. Okay, which is the last 1 year itself, we added more than what we did in the last 10 years. So these investors haven't seen volatility, as I said earlier. They have seen a one-way rally in the market, and markets has been very kind in that sense. And everything has gone back up in the market in the last 1 year, the good, the bad, and the ugly, I would say. And that's where I think one needs to be careful, because in a bullish market and the kind of euphoria what we're seeing at this point in time, everything goes up, even the poor quality stocks goes up. That's where one should be careful and staying away from that. This is the time to be slightly much more discerning and much more careful in terms of the stock selection, or in terms of the quality of the stocks, the companies which are much more stable, where earnings visibility is high. That's what we are doing. And for investors who are investing into funds, I would say that try to look at funds, okay, which are less risky, because each fund has a particular risk return trade-off which is there, right? And each fund is also classified as based on their risk or volatility. I think at this point in time, I would say that it's better to reduce the risk and of one's portfolio, and to that extent, invest into funds, stocks, okay, which are less volatile or less riskier. And there are many funds, okay. If you look at in our portfolio, there are plethora of funds and category of funds. Taking the right advice from your investment advisor and looking for funds, okay, which offer much more stability at this point in time, I think would be very important in this environment. Because I think from here on, if you're able to get a reasonably good return, I think in line with the long-term average returns, 10 to 12% return in equities would be a good return. Don't chase high returns, what one has seen in the last 1 year, because those only come in, when there has been such deep corrections. So more steady returns and moderate returns, I think, is what one should be targeting, and accordingly, one should choose stocks and funds, okay, which fit that. I think that would be the advice for investors at this point in time.